Good evening, students. Welcome to the session. Yes, good evening, Chitala. Good evening, Shankara. Good evening, Manshika. Have you revised what we did in last class? The classification of the income? Yes. Yes, students, all of you should have revised. If you have not revised, please go home and revise today because it's very, very important. And now we are getting into the most important part of your CA final syllabus, which is PGBP. And unless and until you will revise, you will not be able to remember all the provisions. Yes, good evening, Salesh. Good evening, Mansha. Good evening, Viraj. Yes, so have you revised? What did we did in the last class? What did we discuss? Can you just start putting your answers in the chat box so that I know how many of you have revised the class? Yes, students. Classification of income. Revise with me. Tell me. We did the differences in the heads of income respect to salary and PGBP. We saw that there has to be employer-employee relationship to be taxed under salary, contract of service, contract for service. Keep putting your answers, whatever you recollect, without looking at the book. Yes, Mansha, yes, Salesh, you've revised, so just keep putting your answers. Whatever you can recollect, start posting it so that we are on the same page, right? Then we did the difference between IFHP and the PGBP. When it will be taxed under IFHP versus when it will be taxed under PGBP. So, IFHP versus PGBP, yes. Which case law? Name of the case fast. So under IFHP, you can be taxed or the income will be chargeable to tax under IFHP if you are not in the business of leasing out of the property. If you look at the Memorandum of Association object clause and if it is found that you are into the business of the leasing of the house property, then it will be considered as business income. Which case law, students? Chennai property case, right? And the second one was, yes, Salish, correct, Raj Dadarkar. In Raj Dadarkar, the court held that it's yes. In this case, the income would be chargeable under IFHP and not PGBP because the assessee was not able to prove that the main object of the assessee was to do the business of leasing out of the property. Yes, Mansha, correct. Yes, Talish, Shankara, yes, correct. Chennai properties, right? And Raj Dadarkar. Then we did the difference between the PGBP versus the capital gain, which was in respect of the shares and securities. We saw that how the CBDT has given circular to identify what is the frequency of the transaction, what is the intensity of the transaction, what is the holding period, and to determine basically whether you are trading or whether you are investing, right? And then we saw, yes, Mansha, correct. Yes, Manshika. So we also saw what is the speculative transaction. What is the speculative transaction? Under which section speculative transaction is defined? Yes. Speculative transaction is defined under which section? Section number. So I am giving you the rest of the points, but give me the section number. So speculative transaction means the one which is without the delivery. Yes, Mansha, 43.5. Correct. Very good. So do not look at your book and just try to recollect. So 43.5 is correct. And the 43.5 speculative transaction means that it is intraday, the one which is without taking the delivery. But and it is also said a company will be deemed to be in the speculative transaction. The company will be deemed to be in the speculative transaction. When a company is said to be deemed to be in speculative transaction, and what are the exceptions? Yes, Salish, correct. Ravish, correct. Yes. What was the deeming provision? Viraj, then you should not be attending the May 24 batch if you're preparing for November 23 because there are amendments and you would get confused because for November 23, Finance Act 2023 is not applicable, Viraj. So please do not attend this. Yes. What was the deeming provision? The deeming provision said it that a company will be deemed to be in a speculative transaction when it is when the principal business of the company is to purchase and sell the shares of the other companies, right? And what were the exceptions? Yes, Ravish, you are correct. So what were the exceptions? The exceptions were in case I have the gross total income, which comprises principally of income from house property, interest on security, income from other sources, capital gain, then in that particular case, I will not be considered to be dealing principally in the business of the purchase and sale of the shares of the other company, right? And then principal business is either granting of loans and advances, banking or trading in shares. So these were the exceptions. Then what is not considered as the speculative transaction, commodity derivatives, forward contracts, and futures and options are not considered as the basically hedging contracts are not considered speculative transaction. Then we did IFOS versus PGBP. Under IFOS versus PGBP, we saw interest in when the interest can be classified as PGBP, when the interest can be classified as the income from business or profession. The income from other sources. So in case I have the surplus funds, I'm depositing it with the bank to earn, the motive is to earn the interest, then it is of course IFOS. But when it is in the course of my ordinary course of my business, if you remember the case where that I had the interest on the bank guarantee, the margin money obtained for the taking the bank guarantee, in that case, it was in the course of the business, it was arising out of the necessity of the business, therefore it was considered as the PGPP. Similarly, we saw regarding the rental income from the plant and machinery furniture, which is generated, whether it will be PGPP or whether it will be IFOS, it will be PGPP if it is in the, if the renting out is of the commercial asset. So basically, if let's say my factory is in the lockdown and then I have, for the time being, to reduce the loss, I have rented out my assets, it will be PGBP. If it is in the normally I've closed everything, it's not a commercial asset, then it will be income from other source. Dividend will always be income from other source. Yes, Lavish, yes, Shankara, Vanshika, Chitala, all of you are correct. Tuticorin Alkali case, yes, Manik, very good. You remember that case. Shankara, very good. You remember Tuticorin Alkali, they're very good. So we did Tuticorin Alkalis, Bokaro Steel, right? All of these cases we have done that, right? And KN Company case, okay? So this is how the revision needs to be done. See, again in 10 minutes, we did the entire revision, isn't it? This is what is important. So before you go to sleep and next day, when you start with the lecture, you have to revise. So before starting the lecture, we are already revising, but before you go back to sleep, you have to revise. Yes, yes, Vanshika, correct. Tuticorin Alkali was the case name. Yes, very good. So this is how you will start remembering the case name and the section numbers. Okay. Let's move forward. Let's start with the PHPP. But remember, before that, I told you that I will deal with a small concept from the basic concept chapter. What was that? It was the concept of diversion of income by overriding title versus the application of income. I just put it over here in the basic concept chapter. We will put it because it was part of the basic concept. Write down. Diversion of income by overriding title versus the application of income. Now, these are very, very fundamental concepts, and that is why it is coming into the basic concept, right? So, what does this mean? Let's try and understand. Let's first understand the diversion of income by overriding title. Now, in case of the diversion of income by the overriding title, the income is diverted. As the name suggests, the income is diverted. The title is diverted before coming into the hands of the person, before reaching into the hands of the person who is entitled to it, who is titled to it. Before reaching him, the income is diverted from the source. See, under income tax, what did I tell you? With what question do you need to ask under the direct tax, under the income tax? What was the question? What was the question that we asked under income tax? Yes, students, fast. Remember the distinction between direct and indirect tax. What is the question that you need to always ask under income tax? Yes, fast. What is the question? Let me see who remembers. Yes, yes, fast. 30 seconds time to you. I'm not going to give you more time for answering this. Don't flip back your pages. Yes, Shankara. Who is earning the income? Right? This is the question you will always ask on the income tax, because income tax is a tax on the income of a person. right? So in the case of diversion of income by overriding title, it's very important to ask, is earning the income. In this case, the income before coming to the hands of the assessee is diverted from the source of income itself. It is diverted from the source itself. This income from where it is coming, it is diverted at that source itself. So, what, ma'am, we are still not able to understand. How is it basically relevant? So, what happened? The income, whatever it is getting generated from whichever source, is legally diverted by the overriding title and creating a new title for that particular income. So, income is due to me. I am earning the income, but I'm diverting it legally to a third party before it reaches to me. What is the purpose that I'm achieving? The purpose is that it will not be considered as my income, because this income is diverted to another person before it could be considered as my income. So, first you write the meaning. We'll understand by the example that income is diverted at source by the taxpayer before it reaches the taxpayer. Income is diverted by the taxpayer to the third party before it reaches the taxpayer. So in this case, taxability in whose hands? In the hands of third party. The taxability will be in the hands of the third party. Are we getting that? So what happens? What could be the, ma'am, example of this particular scenario? We did not understand. What do we understand by the diversion of income by the overriding title? It's not very clear. So there may be a legal compulsion or a contractual obligation to apply the income in a particular way. So I may be contractually obligated or legally obligated. There exists legal or contractual obligation to apply the income in a particular way before it is accruing or arising to me. So there exists legal or contractual obligation to apply income in particular way before it accrues or arises to taxpayer. Are we getting that? So when the income is diverted at source by an overriding title, before that income is accruing or arising, because I am under the contractual or legal obligation to apply that income in that particular way, then the income will not be considered as mine. Are we getting that? So now, how do we decide how the income has been, or whether the income has been diverted at source? So in that case, how do you decide that? So let's take an example. Let's say there is a person who is liable to pay, certain money as alimony to his wife. He is divorced with his wife, so he is required to pay certain money as alimony to his wife. Now, he is under the legal obligation to pay that amount to his ex-wife. Now, what he will do is, let's say, for example, he will go to his employer and ask and instruct that look, can you, instead of me paying the salary of 10,000 per month, can you just pay that amount to my wife? So in this particular case, Mr. A is under the obligation to pay the amount as alimony to the wife out of his income. So therefore, when he is instructed to the employer, so though the income is mine, but I have instructed to my employer not to give me this amount, at the source itself, I am diverting my income to my ex-wife. That income will not be considered as mine. So this is the income of mine income, right? Which is applied by me to fulfill an obligation, right? To fulfill an obligation. So in this particular case, can you consider that this is my income or this is the income by overriding title? So here there exists the obligation of Mr. A to pay to his ex-wife out of my income. Now this, if you look at it, whose salary it is? It is my salary. I'm not writing anything on screen. Is the screen visible? One second, I'll just reshare it. Yes, is the screen visible, students? So who is earning the income? Mr. A is earning. I have just instructed to my employer that kindly do not pay me this salary and pay it to my ex-wife because I am under the obligation to pay to my ex-wife as alimony. So whose income it is? Is it diversion of income by overriding title? It is, yes, Ravish, it is income of Mr. A. So can I say this is now income of Mr. B? Income of A's wife, Mrs. B, let's say. The answer is no. Because here I have to make the application of my income. I have to pay alimony from my income, but that is the application of income and not the diversion of income by overriding title. So even if at the source I am asking to pay to my wife instead of me, this is not diversion of income. It is my income. Who is earning the income? Mr. A. So it will be considered as income of Mr. A. This will be considered as, in fact, the application of income. So, what is important to distinguish between diversion of income by overriding title versus the application of income? You need to decide whether the diversion has accrued or diversion has happened before the accrual or arising of income. If the diversion has happened before accruing or arisal of the income, it can be said to be diversion by overriding title. It should not happen after the accrual of income. What did I say? The diversion should happen. There should exist the legal or contractual obligation to apply the income in a particular way before it accrues or arises to the taxpayer. If it happens after it has accrued or arises, then it's an application of it. So in this case, the salary has accrued to me because I have rendered the services, I have received the salary. Now, just because I tell my employer to pay it to some other person, to my wife, it doesn't mean that it is not my income. It is my income. It has accrued or arisen to me. So that will be considered as application of income. So what is application of income? where the income is applied by the taxpayer for a specific purpose. Where the income is applied for a specific purpose, application of income, which is normally what you understand. Let's say, for example, you are applying the income out of the charitable trust for the charitable purpose. That is application of income, isn't it? That is clear-cut application of income. That is not diversion of income by overriding title. Are we getting that? So application of income envisages that first the income accrue or arise and then you apply the income. So wherever you may apply, that will not be deductible. That will still be considered as my income. Right? Now, in case, then what is the diversion of income by overriding title? So let's take another example. Let's say there is a partnership firm. Right? There's a partnership firm. There are three partners, A, and there are his two sons who are partners in the partnership firm. Now, their partnership deed will provide that, let's say, after the death of Mr. A, Mr. B and C, his two sons, will continue the partnership, subject to the condition that 20% of the profits of the firm will go to the wife of Mr. A, who has died. Now, after, let's say, Mr. A dies, 20% of the profits of the firm will regularly go to Mr. A's wife, their mother, basically. So this income, there's a contractual obligation under the partnership deed that once Mr. A will die, there is an obligation on the partnership firm to pay the amount to the wife of A. Now, this income was diverted before its accrual. This is the case of diversion of income by overriding title. So the firm may have received the amount, but 20% has to be transferred to Mrs. A. Therefore, this income will not be considered as firm's income. This income will not be considered as firm's income. Because here it is being diverted before it could accrue or arise to the firm. Are we getting that? Let's take a few more examples to understand. Let's say there is an advocate. There is an advocate. Now, what he is doing is, he has agreed to defend one case in the Supreme Court. And he has agreed that whatever fees he will get out of that case, he will argue. He would then provide it to a public charitable trust. So he created a trust, a public charitable trust, and whatever amount he used to receive from the case, he used to pay to the trust. Whether this is application of income or whether this is diversion of income by overriding title. Yes, fast. Whether this is application of income or diversion of income by overriding title. Mr. A has received the amount from the clients and he has applied it to the charitable trust. It's an application of income. Yes, Ravish, you are correct. This is not diversion of income by overriding title. I have received the income, now I am applying it. This is considered as application of income. Yes, Vinay, very correct. So this is the application of income. Are we getting that? Second example. Let's take one more example. Let's say there was a sole proprietor. there was a sole proprietor. He took over the running business, or let's say there is a company who took over the business of sole proprietor. Now, there were certain charges which the company had to pay to get over that business. To get that particular business, there were some litigation charges which had to be cleared off. Now, whether that is diversion of income by overriding title or it is an application of income. So, whatever the business was taken over, the income which was generated out of that. So, the amount had to be paid towards clearing that litigation charges. Whether this will be diversion of income by overriding title or application of income. Yes. Fast. Yes, students. Diversion or application. Ravish, no. How is it application? Mohammed, no, it's not application. It is diversion of income. Yes, Mancha, it is diversion. Vinay, there is no income. No, there is an income. So see, in this case, there were certain charges which had to be cleared off to take over that sole proprietary concern. Otherwise, the going concern status would have been affected. Now, whatever income I will earn, I will have to first pay the litigation charges. So there was an obligation to the source of income. So whenever the company will start generating the profit, first it has to clear the litigation amount. That is how it is diversion of income by overriding title. Vanshika, it is diversion and not application of income. Yes. So there's, very, very thin line of difference between the two, but you have to see whether before the accrual of the income, the diversion has been created. Okay. Viraj, but as I said that if you are giving November 23, you should not be attending May 24 batch because it will in fact confuse you. We are doing a lot of new concepts which are applicable for Finance Act 2023. It may confuse you, so it is better that you refer back to the last year's recorded lectures which are available on YouTube. I think that will be a better deal. Okay? Because unnecessarily you will get confused and then you may end up writing the amended answers, whereas you are not supposed to write that for November 23 exams. Okay. Now let's proceed further. Let's go back to PGBP. Okay. So getting on to section 28. Section 28 of the Income Tax Act. Now remember, under each of these heads of income, there will be the general charging section and there will be a specific charging section. First, we will always deal with the general charging section, which is 28(1). What does it say? 28 says, the following income shall be chargeable to the income tax under the head PGBP. 28(1) says, what shall be chargeable? Profits and gains from any business or profession. From any business or profession which was carried on by the assessee at any time during the previous year. at any time during the previous year. Now we will understand this by breaking it into one by one. Vanshika, it would be one-time obligation, but then that is not a determinative factor that whether it is a one-time obligation or whether it is regular obligation. What is important is that before the income could accrue, you are diverting it at the source. So that is something which you need to take into consideration, Vanshika. Okay? Okay. Now let's deal with it one by one. We were going to dissect this definition like you would have never understood before. Okay? So let's deal with it. Section 28 says profit and gains. Now, what do we understand by the term profit? What do you understand by that word profit? Yes. What do you understand by the term profit? Yes. How do you understand profit? How do we understand the term profit? Yes, students. Fast. Okay. So profit and gains. How do you determine profit and gains? It says profit and gains. Sales minus all expenses. Yes, that's correct, Vinay. So profits are to be understood as per the commercial principles of the accounting. So profit and gains means what? As determined as per the commercial accounting principles by applying your accounting standards, by applying the Ind AS. So basically, whatever system of accounting you are following, cash system, accrual system, that has to be taken into consideration. So profit and gains means what? As determined as per commercial accounting principles. Now, cross receipts after allowing expenses. Yes, Ravish, absolutely correct. So, however you commercially determine, that is what you understand by profit. So, income is not chargeable. What is chargeable is profits and gains. Profits and gains. They are not saying income. They are saying profit and gain. Now, from 28, section number 28, mind it, be very, very careful and be very attentive. Not even for 1 minute you are going to lose your attention. We are referring to section 145, method of accounting. See, Income Tax Act is not to be understood in isolation. You cannot understand Income Tax Act in isolation. That we will read 28, 35, 40, then we will go to 145 sometime later. No. We have to make reference to 145 now. Because how will I determine what is profit and gains? So 145.1 says that income chargeable under the head PGBP. Income chargeable under the head PGBP will be computed in accordance with either cash or mercantile system of accounting regularly employed by the assessee. So basically 145.1 is telling you that you can choose to compute your profits and gains. You can choose to compute your profit and gains by using either cash or mercantile. Mercantile is accrual system of accounting regularly employed by assessee. So 145.1 is saying that whatever you are preparing your books of accounts in whichever method, you can choose to follow that particular method. You can choose to follow that particular method. Are we getting that? Yes or no? Yes. So 145 is asking you that you have to basically follow whatever method you are following. Now, 145.1 is telling you that, okay, you follow the commercial accounting principles. And that could be either as per the cash or the accrual system regularly employed by the assessor. Now, 145.2 is saying central government may notify ICS, income computation and disclosure standards. 145.2 is saying that central government may notify ICDS, and in accordance with the powers granted under 145.2, indeed the central government has notified the ICDS. So ICDS are notified, right? So ICDS are notified under or in accordance with the power granted under 145.2. So 145.2 empowers the central government to notify ICDS. Are we getting that? Now, if you look at it, now let's have a look at the ICDS. Now, ICDS are for the purpose of maintenance of books of accounts. Is ICDS for the purpose of maintenance of books of account? So, central government wide notification of 2016 notified the ICDS. So these ICDS are to be followed by all the assessees other than the ones who are not required to get their accounts audited. And ICDS is applicable only when you are following the mercantile system of accounting. So, understand this thing very, very carefully. ICDS is not applicable when you are following the cash system of accounting. ICDS is not applicable when you are following the cash system of accounting. It is applicable only when mercantile system is followed. mercantile system is followed and it is not applicable to individual or HUF, not required to get books of accounts audited, who are not required to get the books of accounts audited. And this is applicable only when you are following the mercantile system of accounting. When you are following the cash system of accounting, is this applicable? The answer is no. Now, what is ICDS? Is it for the purpose of maintaining the books of accounts? No. It is the income computation and disclosure standard. And as the name is suggested, it is for the purpose of computing the income, and how the income is computed, you need to disclose it as a part of your tax audit report. So how the income is computed, how will you disclose it? The disclosure needs to be made in the tax audit report. Have you filed the tax audit report? You have seen the tax audit report during your articleship. In that, there is a specific clause. If I remember correctly, it's clause 40, which asks you the details of how you have computed the income as per ICDS. Yes, good evening, Geeta. So basically, ICDS is for the purpose of computation of income and disclosure in relation to that. So there were doubts with respect to the ICDS. There were various doubts that were there when the ICDS was basically notified. And to clarify the doubts, the CBDT came up with a circular. And in one of the questions, it has came up with basically the FAQs, frequently asked question, and it clearly says that it is not for the purpose of maintenance of the books of accounts. ICDS is not for maintenance of books of accounts. The books of accounts will be maintained as per the commercial accounting principles. For example, companies are required to prepare or maintain the books of accounts as per the Companies Act, as per Schedule 3. So this is not for them. It is for the purpose of computing the income under the head PGBP as well as income from other sources. Are we getting that? Now, next question is, what are the different ICDS? Now, different ICDS, we will not do it now. We will do it at the relevant point of time when we are dealing with the relevant income or relevant expenditure for which the ICDS is providing the guidance. For which the ICDS is providing the guidance. So we will deal it at that specific point of time. We are not going to deal it at the moment. But yes, the first ICDS, which talks about the accounting policies. That's what I'm going to touch upon now. So ICDS 1, because since we are talking about the profit and gains, and we said as per commercial accounting principles, so ICDS 1 is giving us certain accounting policies. And what does it say? It says there are following are the fundamental accounting assumptions. So these fundamental accounting assumptions are to be taken into consideration while computing the income under the head PGBP. Number 1, going concern, right? So going concern means what? That the person has person does not have basically the intention of closing down the business. So there is a foreseeable intention that the business, profession or vocation will get continued for a foreseeable future. Second one, consistency. So that accounting policies are kept consistent from period on period. It should not happen that I'm varying my accounting policies without any considerable reason. So there has to be a consistency. So if there is only some material effect, if there is some inappropriate treatment, then only I will change my accounting policies. And for that, I need to make a disclosure. If there's change in the accounting policy, which has certain material impact, that shall be disclosed in the audit report. Right? Or if I am not following these going concern principle, accrual principle, consistency principle, then I need to make an appropriate disclosure. Third accounting assumption is accrual. So what I said, ICDS is applicable only when you are following the accrual system of accounting. When you are following cash system, you are out of the ICDS. You are out of the ICDS. Are we getting that? So only when you are following the accrual system of accounting, then only you need to report. Accrual means that the revenues and the cost are recognized on the basis that whenever they are incurred. Right? So that is what basically ICDS 1 is talking about. Are we clear? Okay. So this is ICDS 1. So it says that the business profit or the professional income has to be computed based on the going concern, consistency principle and accrual. These are the three accounting policies. Next important ICDS that we are going to deal with at this particular moment. ICDS 4. Revenue recognition. What we are talking about? Profit and gains. Do not lose the touch with the heading that we have started with. It's profit and gains that we are trying to discern the meaning of. It says profit and gains means what? Profit and gains means what I understand as per the commercial principles of accounting. 145.1 says that you can follow the cash or mercantile, whatever system you are following regularly. And 145.2 gives the power to central government to notify ICDS. And notified ICDS are applicable only when you are required to follow or when you are following mercantile system and you are not individual or HUF who is not required to get the books accounts or who is not required to basically get the books accounts audited. So ICDS 1 is saying that you follow the accrual basis of account. Now we are talking about the revenue side. Income, gross receipts. What is profit and gains? Profit and gain is income minus expenses, what you said, or revenue minus expenses, what you rightly said. So when I look at my P&L, this is revenue, this is expense. So you start your question from the net profit as reported in the P&L account. You start with the net profit as reported in the P&L account. Even when you look at section 29 of the Income Tax Act, we are under section 28 at the moment. So section 29 tells you that the income under 28 has to be computed as per 30 to 43D. And we follow certain format, isn't it? We follow a certain format for computing the PGBP income. What is that format? The format is we start with the net profit as given under the P&L or as reported under the profit and loss account. Isn't it? So you start with that and then you make the additions or deletions. So the important point over here is now, first we will start with the revenue side. First we'll start with the revenue side. So ICDS 4. ICDS 4 says that the revenue recognition from the, what is the revenue recognition? The cash or whatever receivables or any other consideration which is arising in the ordinary course of my business. Now the revenue, how do we recognize? So in case of sale of goods, in case of the sale of goods, the revenue shall be recognized when the seller of the goods has transferred the property to the buyer. When the seller of the goods has transferred the property in the goods to the buyer. Which means what? When the seller is transferring the risk and rewards of the ownership to the buyer. Which means what? That the seller does not have now any control over the goods. Right? Now, what do I mean by seller has transferred the property in the goods to the buyer? What do I understand by that? Contract Act, Sale of Goods Act, CPT exam. Yes. Yes. What does Contract Act, Sale of Goods Act say? Yes. When do I say that the property in the goods has been transferred to the buyer? Do you remember the concept of CIF, FOB? What was that? When the ownership is transferred, Vanshika. Yes. See, you have studied CPT. You cannot say we forgot it. There's a reason why the CA curriculum is designed in this particular way. That you have studied sale of goods. It was not a waste of time. It was for a purpose. Yes. What does Sale of Goods Act say? Yes, students. Yes. Anyone? So if you remember, there was section in the Sale of Goods Act. See, this is how the studies have to be done. Risk and reward, yes. Vinay, that's correct. Whatever I have written, you're saying same. That risk and reward is transferred and seller has no control. So, yes, Ravish, very good. Whether buyer has performed, whether seller has in fact performed, not the buyer, the seller has performed the part of the contract. So, section 26 of the Sale of Goods Act, it says that the goods remain at the seller's risk until the property is transferred to the buyer. When the property is transferred to the buyer, the goods are at the buyer's risk, whether the delivery is made or not. So when the goods, that it depends on the contract of sale. It depends on the contract of sale, that how my contract is worded. So if, let's say for example, if the contract says that this is going to be FOB, freight on board, in case of import of goods. In that particular case, the moment the goods leave the foreign port, the risk lies with the buyer. That means the property in goods has been transferred to the buyer. Recognize the revenue at that point of time. But let's say when it is CIF, cost, insurance and freight contract. So until the goods reach the Indian port, the risk lies with the seller. If there is something, the buyer will not accept the delivery. Isn't it? So in that particular case, I will recognize the revenue when the contract of sale is completed. When the contract of sale is completed. So what is a contract of sale? Contract of sale means what? That whenever the contract of sale is made by an offer to buy or sell the goods for a price and the acceptance of that offer. So when the contract is finally said to be completed, when I deliver the goods in accordance with the contract. Are you getting that? So the property is transferred to the buyer as per the contract. Whether when the goods, when they are leaving the factory at that point of time, the transportation, if it is on the buyer, then the property gets transferred when the goods leave the factory. In that case, I will recognize when the goods leave the factory. But let's say where the contract says no, until and unless the goods reach the factory of the buyer, till that time it is the responsibility of the seller. In that case, the property will transfer when the goods reach the buyer properly. Are we getting that? So you have to read the contract properly to determine when the sale has to be recognized. Yes, Vinay, when the performance obligation is satisfied. Are we getting that? So that is for the sale of goods. Now, in case of the sale of goods, it also says that the revenue shall be recognized only when there is a reasonable certainty of its ultimate collection. So, revenue shall be recognized only when there is reasonable certainty of ultimate collection. If it is doubtful that the collection may not happen, you can choose not to recognize the revenue. Because let's say, for example, in big contracts which are there for the construction, for any installation, for any kind of, let's say, interior work, civil work, there is always that escalation price which is there. There is always that escalation price, or there is always that, some amount is retained. There is some retained money, which may or may not be collected. Because if you do not complete the contract to the satisfaction of the buyer, then in that particular case, that amount may not be collected. So the revenue, in that case, I cannot recognize the entire amount, the retained amount, which is there, which is uncertain. I can only recognize when there is reasonable certainty of its collection. Or let's say, for example, if I have, let's say, in big contracts, in the civil contracts, in the building contracts, there could be escalation of price, because let's say my material has become expensive, so I'm escalating the price. Or let's say, for example, in case I'm making the export, so I may receive certain incentives from the government, export incentives. Now these, how can I recognize unless there is a reasonable certainty? So I will have to recognize only when there will be a reasonable certainty. Unless there is reasonable certainty, I will not be able to recognize. Example, escalation price or export subsidies. Clear? Now, in case of these services, revenue in case of these services, this is for goods, for the services. For the services, it says you have to recognize the revenue on the basis that what is the period of the contract? What is the period of the contract? So, you have to see whether the contract period or the duration of the contract is less than 90 days or more than 90 days. So, duration of the contract if it is less than 90 days, if the duration of the contract is less than 90 days, then you can recognize the completion method. You can recognize for the revenue on the project completion method. Let's say, for example, if I have a service contract, let's say I am a service provider, I am coming and inspecting the entire project. Now, let's say the contract period is for 6 months time. Or let's say the contract, not the 6 months, if it is less than 90 days, let's say the contract period is of 2 months. Now, the 2 months, let's say, are March and April. Now, the question will arise, when will I recognize the revenue? I would have started receiving the professional fees in the month of March, because I would get the professional fee in installments. Now, will I recognize the professional fees of March in the March financial year? Or will I defer it to April when the contract gets completed? I can defer it to April and I may not recognize anything in March. If the contract duration is less than 90 days, I will recognize on the project completion method when the contract gets entirely finished, when I complete all the duties in the contract. If the contract duration, if the duration of my contract is greater than 90 days, then follow the percentage completion method. Follow the percentage completion method. Which means what? That the revenue from the transaction will be matched with the transaction cost. And you will determine the stage of completion. Based on the stage of completion, you will recognize the cost in the income. Are we clear? However, if let's say for example, there is no clear-cut period which is there based on which you can determine that whether there is any percentage of completion which can be achieved, because it may sometimes happen that there could be, there may be a contract and I may have to, let's say one part of the contract is inspection, second part of the contract is, let's say, me making some technical drawings and designs, third part of the contract may be, let's say, me just doing the supervision. So there are indeterminate acts. It's not, one single coherent contract. So I may not be able to use a percentage of completion method, because percentage of completion method, we know that there are stages of the contract which should be achieved, and based on those stages that I have achieved, I will recognize the revenue and the cost. Here there are indeterminate acts. In that case, if there are indeterminate acts, ICDS 4 says recognize on the SLM basis. Recognize the revenue on the straight line basis over a specific period of contract. Clear? So that is the revenue for the services. We have seen for the goods, recognize when there is property in goods as past, but there should be reasonable certainty of collection. In services, you either follow the project completion method. If it is less than 90 days, if it's more than 90 days, follow the percentage completion method. If there are indeterminate acts, you follow the SLM. Now, in case of interest, interest on refund of any tax, interest on income tax refund, interest on income tax refund. Ma'am, but income tax refund interest, is it even a PGBP? PGBP income? Interest on income tax refund? Is it PGBP? Yes. First question that should come to your mind. Interest on income tax refund, is it PGBP? Yes or no? Interest on income tax refund, PGBP or income from other source? Yes, Ravish. Yes, Vinay, it is income from other source. But as I said, ICDS is applicable to both PGBP and income from other sources. So it says interest on income tax refund has to be deemed to be the income of previous year in which interest is received. Previous year in which interest is received. So it could happen that by 31st of March, you would have received your 143.1 processing of order, summary assessment order. And the refund may get credited to your account in, let's say, April. So you will recognize the interest in the year in which it is received in your bank account. Fine. But write it over here. This will be income from other sources. Discount or premium on debt securities. Discount or premium on debt securities. In that particular case, the premium on securities is recognized over the period of the debt. So premium on debt over the period. Next is royalties. Royalties will be recognized based on the agreement of the royalty. Whatever the agreement will say, based on that, it will be recognized. Based on the agreement. And finally, dividend as per the Act, and Act will say Section 8 of the Income Tax Act. Again, this is income from other sources. So this portion, we will again do it when we will do the income from other sources. Except this, royalties is part of the PGBP. So we will again do it when we will do income from other sources. Fine. But I'm just giving you, you may, not note it at the moment. We can note it when we will do income from other sources chapter. Otherwise, it may create certain confusion for you. Are we clear? Yes or no? Yes, students. Now, one more important thing in terms of the recognition of revenue. One more very important aspect. There is additional section which has been introduced, which is section 145B. Section 145B. Section 145B says what? That in case of escalation of price or export incentives, this is what we did over here, right? The escalation price or export incentives, what the ICDS force is recognized only when there is reasonable certainty of ultimate collection. This is what even section 145B also provides. 145B also provides for the same. Now, 145B also talks about one more income. What is that income? It talks about the subsidies or grants or cash incentive. Subsidies, grants or cash incentives or duty drawback or loan waiver or any concession or reimbursement received from the central government or the state government. So, let me do this thing. I'm removing here this interest on income tax refund and this, because this we will any which ways do in income from other sources. Sorry. Because otherwise this may create unnecessary confusion. Just for the purpose of your understanding, I just put it over here. So royalties, any which ways I'm writing here. The other sources is just I'm written. Okay. So subsidies or grants or cash incentive subsidies, grants or cash incentives or duty drawback or loan waiver or concessions from the government recognized in the year in which it is received. 145B says recognized in the year in which it is received. This is section 145B. Yes. So what were we on? Profit and gains to be computed as per commercial principles of accounting. 145A says cash or mercantile. ICDS says accrual system. Only if you are following, then only you come to ICDS. You should follow going concern, consistency and accrual principle under ICDS. Second, revenue recognition. For the revenue recognition for goods, when the property in goods is transferred to the buyer. But you can recognize, let's say for example, escalation claims, export incentives only when there is reasonable certainty of collection. For the services, if it is less than 90 days, project completion method, more than 90 days, percentage completion method. If there are indeterminate acts, SLM. Finally, for the royalties, you go as per the contract and for the purpose of the subsidies, loan waiver, recognized in the year in which it is received. That is given by 145P. Fine. Are we clear? Now, what else will come in your trading and P&L account on the revenue side? What else does it come? Basic accounting. What else do you see in your trading P&L account? On the revenue side, what else? Other sources we will talk about later. Interest, dividend, let's not talk about it now. We have already discussed it any which ways. What else will come? Other income, Ravish, as I said, we will deal it in the IFOS lecture. One very important thing which comes up. Yes. In the trading account, what is the another thing that we take into consideration? No winner, not discount received. Discount received is fine. But when you prepare the trading account, how do you calculate the gross profit? Sales and what else? Yes. Basic accounting students. Direct income is fine, Vinay, but not the direct income that I'm talking about. Yes, Ravish, very good. Closing stock. So you take sales, you take closing stock. So we are now going to talk about the inventories. ICDS 2, inventories. But before that, again I go back to section 145A. Section 145A talks about that for the purpose of determining the PGBP, the inventory shall be valued at section 145A says valuation of inventory. How do we value inventory? At the cost or net realizable value, whichever is lower. At the cost or net realizable value, whichever is lower, which shall be computed. How do we compute the cost and the NRV? For that, refer to ICDS. So it says 145A says that the cost or NRV, whichever is lower, you need to take. But how do we calculate the cost or NRV? You refer to the ICDS 2. Are we getting that? Now here, very important point. Here, it also says that the value of the purchase and the sale of the goods, or for that matter, the services, and that of the closing stock will include the tax, duty, respectively, which is paid or incurred by the assessee. So, it says that the taxes will be included to the sale, purchase, and closing inventory. So basically it is saying you follow the inclusive system of accounting. So there is inclusive and the exclusive system of accounting. In the exclusive system, you do not take the taxes to the P&L account. You maintain it in the balance sheet. Whatever you collected, whatever you have paid, the balance credit or debit will be reflected in your balance sheet. Whereas in the inclusive system, whatever you have paid will appear as a part of your purchases. Whatever you have collected will appear as a part of your sales and as a part of the closing stock. And the balance will be depicted as your expense. Right? So basically 145A is saying you follow the inclusive system of accounting. And you include the taxes which are there. Now here, the inventory that we are talking about in the ICDS 2 is other than the securities. We are not talking about at the moment the inventory which is securities. We are not talking about inventories which are securities. So here we are talking about the inventory which is the goods other than the security. Now this may include the raw material. This may include your finished goods. This may include your work in progress. But we are not talking about the shares, debentures which are held as inventory. Similarly, we are not dealing over here with the flats which are held as inventory, because that will be dealt with by the construction contract ICDS. Are we clear? So what is inventory? Inventory is basically which is held for sale in the ordinary course of business, or which is held for the production process, or which is in the form of raw materials. So when it is saying that you refer to the ICDS, the cost or NRV, whichever is lower. So my cost here means the actual cost, which is incurred in bringing the inventories to their present location. So cost is cost incurred to bring inventory to present location, which means it will include the duties, taxes, freight inwards, and any expenditure directly relating to the acquisition. Similarly, trade discounts will be deducted. Trade discounts will be deducted. So, includes freight, or let me put it this way, valuation of inventory. So, for the raw materials, this will be the actual, let me write it this way. For the raw material, there will be actual cost of purchase, right? Plus freight, plus duties and taxes, minus my trade discount. Any expenditure directly related to purchase. Right? In case of similarly finished goods also, it will be the same thing. In case of WIP cost, in case of the work in progress inventory, it will be the cost of conversion. In case of the, this is for raw materials or the finished goods. For the work in progress, it will be the conversion cost. What do we mean by the conversion cost? It means the cost which are directly related to the production, meaning the variable cost and the fixed cost. So you systematically allocate the fixed cost, the standard costing, marginal costing that you have learned, right? Which are incurred in converting the material into the fixed finished products, basically. Are we clear? So fixed cost, how do you allocate based on the normal capacity of production? So you divide the entire fixed cost divided by the normal capacity. Right? You take the normal capacity and not the extraordinary or underutilized capacity. You take the normal capacity basically. So you take the normal capacity and divide the fixed cost, and that will give you the cost per unit. Are we clear? So you don't take the abnormal or the actual capacity, but you take the fixed cost by in the terms of the normal capacity, which is what you do in the marginal costing. Are we clear? Then what do you exclude from the inventory? You will not include selling cost or administrative overheads or any abnormal cost, that you will not include. Are we clear? And what basis of inventory valuation you will follow? First in, first out, or weighted average. So you will use, the cost will be determined on FIFO or weighted average. FIFO or the weighted average. Are we clear? And what about the net realizable value? So this is about the cost. For the net realizable value, because as we said, the lower of two So net realizable value will be on the item by item basis. The net realizable value is basically the market value. You will take the estimates. So here you take the on the item by item basis. So you will not aggregate, but you will take on item by item basis. So for the same product line, you will combine all the items, and based on different product line, you will take all the other items. Okay. Any doubt? Yes. Last one point in respect of the cost or NRV, whichever is lower, right? Now, where let's say, for example, if there is WIP, now the WIP will not be valued at NRV if it is lower than the cost. If the finished products in which these WIP or raw materials are to be incorporated are expected to be sold above the cost. Are we getting that? So if it is observed that the finished goods will be sold above the cost, then we will not take NRV into consideration. But where the cost of finished products is going to exceed the NRV, then only NRV will be used. Are we clear? Yes? Any questions? Any doubt? Vanshika, inclusive means you take the taxes in the P&L account and the trading account. Whereas exclusive means you take the taxes through the balance sheet where you show it under receivable or payables. Okay. Now we'll take a small break and then we do the ICDS 8, which is for the securities, because the securities which are held as stock in trade. So the next ICDS that we are going to touch upon is ICDS 8, securities, the valuation of securities, basically, right? Okay, so that we will deal it after the break. Let's take a small break of 10 minutes. Okay. Yes, students. So we'll start with now the securities ICDS A. Um, Refundable taxes, Chitara, no. We should not exclude from the inventory. We have to include whatever we have paid. That will be part of the purchase. So that will automatically come to your inventory. Whatever we have collected, that will be part of your sales. So basically, inventory will have the whatever we have paid as a part of purchase will get reflected in inventory. So that will be basically your input tax credit. So whatever is reflected in inventory, what you have not sold, that will be basically your input tax credit only. Okay? Okay. So let's go with the securities, which is ICDS 8. Now, the ICDS 8, which is there, this deals with the securities held as stock in trade. Securities held as stock in trade. Okay? Now, what does it say? That the security shall be recognized at the cost. The security will be recognized at the actual cost. Now, what is the cost? What is the actual cost for the security? The actual cost is because at the year end, when you will value the stock, it has to be recognized at the cost or NRV, whichever is lower. Same like we had it for stock in trade, normal stock in trade. So what is my cost? Cost is the actual cost. Now, actual cost will mean what? The purchase price and the brokerage, fees, duty, taxes, all of that will be forming the part of purchase cost. Include brokerage, taxes, fees, right? So all of that will be included. Well, let's say, for example, if the security is acquired in exchange of any other asset, then it will be the fair value of the other asset. So security acquired in exchange of other asset or security, then the cost will be fair value of other asset or security. So it could happen, like let's say, for example, you are purchasing a machinery. So in case that, you are purchasing a machinery and you may be allotted certain securities of the other company, right? So in that particular case, it will be the fair value of the other security or the asset. Are we clear? Now, as I said, it has to be recognized at the cost or net realizable value, whichever is lower. Now, this will be on the basis of each category wise. You will not do the comparison of cost or NRV, whichever is lower, on the individual security wise, but you will do it on the category wise. This will be done. Cost or NRV, whichever is lower, will be done category wise and not individual security wise. What do you mean by that? So let's say, for example, now it is quite possible that I may have under the securities, let's say 5 shares, Reliance, Tata, Adani, then ICICI Bank, HDFC Bank. So I will not do each individual security wise. What I'll do, I'll aggregate the cost of all these I'll aggregate the NRV of all these and then take the cost or NRV, whichever is lower. Are we getting that? So the aggregate cost and NRV of each category of security are compared, and the lower of the two is to be taken as the carrying value as per ICDS 8. So ICDS 8 says that the comparison of the cost or NRV shall be done category wise and not for each individual security wise. Are we getting that? So basically, if I have to say, for example, let's say the cost, this is NRV, let's say this is Reliance, this is Adani, ICICI, HDFC, let's say Tata Motors, this is Titan, let's say this is 100, this is 150, right? This is 120, let's say this is 75, this is 140, this is 120, this is, let's say 200, let's say this is 190. Okay, let's take these much on for the time. So let's say this total comes to 560, this total comes to 535. Now I will not do like this. I will, if I do like this is coming to 505. I will not do like this. I will take the lower of this. So 535 will be my valuation. So it has to be done category wise. This has to be done the category wise and not individual security wise. And what will be classified in the security? Under the security, we will have the shares, debt, convertible securities. So basically all securities are going to be covered over here. So shares, debt, convertible securities are covered. Okay. Any questions? Any doubt? Again, here you will recognize the cost on the basis of FIFO or weighted average. So the cost here will be on the basis of FIFO or weighted average. Yes, any question? Any doubt? Are we clear? Yes? Vinay, I didn't get it. What is Deepak fertilizer? Okay. So this is about the profits and gains. Okay, so under profits and gains, what did we see? The commercial principles of accounting. We saw 145, which says accrual or cash basis, whatever you are following. Then we saw that we have the ICDS 1, which says that, or ICDS basically is saying to you that you follow either the cash or the ICDS is applicable only when you follow the accrual system of accounting. It was not applicable to individual or HUF who is not required to get the books of accounts audited. Are we clear? Then we went to ICDS 1, which says that you have to follow 3 fundamental principles: going concern, accrual, and consistency. Are we clear? Then we saw ICDS 4, which is the revenue recognition. Now, revenue recognition, which is basically there for the goods, it is on the transfer of property. For escalation price, export incentive, when it is, then there is reasonable certainty. Then for the services, it is on the project completion method. If less than 90 days contract, if more than 90 days, then percentage completion. If there are indeterminate act, then SLM. For royalties, you refer to the contract. Then for the duty drawbacks, for the concessions, for the waiver of loan, subsidies, it is in the year in which it is received. Are we clear? Then for the inventory, we saw cost or NRV, whichever is lower. Cost will include your duties as per 145A. It will include your duties. It will also include whatever the transport charges, freight and all warranties which are paid basically to bring the goods to the location. An NRV you will take into consideration and then you will determine the price. Similarly, under securities also cost or NRV, whichever is lower. The cost will include the duties, fees and brokerage. And you will do each category wise and not individual securities. Are we clear? Yes or no? Any doubt? Yes. Any question? Any doubts? Yes or no? Clear? Okay. So let's proceed further then. Now again, if you look at ICDS 145A, it also provides the same thing even in respect of security, that it has to be at the cost or market value or the net realizable value, whichever is lower. So 145A is also reiterating the same particular point. Yes. So now we were on the point of what? Profit and gains. Profit and gains. So now profit and gains of what? Of business or profession. Now what do I understand of the word business or profession? What do you understand by the term business? Yes, what do I understand by the term business? Yes, students. So business is defined. Business is defined under section 2. So what do I understand by the term business or profession? Both of them are defined. So business means any trade, commerce or manufacture. So my first point was profit and gains from any business or profession. So business means section 213 defines business as includes any, it's an inclusive definition and not an exhaustive definition, includes any trade, commerce or manufacture or any adventure or concern. In the nature of trade, commerce or manufacturing. So basically, business means anything where I am doing an organized activity. Right? It means when I am doing an organized activity of trade, commerce or manufacturing. It should not be an isolated transaction. Let's say, for example, today I am selling the land. It's a one-off transaction. But let's say if I am doing an organized activity of developing that land and then selling it off, that is what I am doing, the business of developing and selling the land. So there was a distinction between IFHP and the PGBP. When I said that I am into the business of developing the property and leasing it out, I am in the business. I am doing that organized activity. If my motive is not to do business in leasing, it is not my business to do the leasing. I have only one property which I have let out. It is IFHP. But when I have multiple properties and I am into the letting out of the business, that is where it will be under PG. What is profession? Section 236 defines profession to include the vocation. So, Profession means what? Profession generally means, section 236 just says, profession includes vocation. Profession includes vocation. That's what it says. It doesn't define profession. Profession means where I am having some professional degree and professional knowledge with which I'm able to give that kind of expert services. For example, we as chartered accountants are professionals, isn't it? So profession includes the vocation. Now, what do we understand by the vocation? Vocation means any kind of, let's say, these, priests are there, these religious, spiritual leaders are there. They are basically exercising the vocation, right? So they are carrying out a vocation. So profession will include the vocation also, where I'm doing something as a part of my kind of uh, that extra, or how do I put it? Like, that I have that some additional knowledge which I'm able to utilize. So that is something, or I have like a particular skill set. Vocation means that I have particular skill set that I am making as a career or occupation. Are we getting that? So that is the meaning of term vocation. So profit and gains from the business or profession carried on by the assessee. Carried on by the assessee. Now, what do I understand by the carried on by the assessee? So the business has to be carried on by the particular assessee. It could also include the agent of the assessee. It could also include the agent of the assessee. So it may not necessarily be carried on by me only. It could also include agent of assessee. So let's say, for example, I may have like, an agent who is carrying on the business on my behalf. Again, going back to the contract act, contract of agency. The one who does it through agent does it himself. If I'm doing something through the agent is representing me and it will be like that I have done it myself. So that is the contract of agency. And there is a Latin term which you may not remember, but I'm just, giving you that in the Latin, there are certain legal phrases. So this is just additional knowledge that I'm sharing across, but it's not meant to be, you should remember. Qui fecit perellum, persit per se. Ma'am, is it Latin or is it Chinese? It is Latin. But what does it mean? It means that the one who does it through the agent does it himself. So if I'm doing any act, the agent is acting on my behalf. And it will mean that legally I have done that act. That is what the Contract Act also says. Again, I'm taking you back to CPT. Okay? So it means carried on by the assessee means that it includes the act which is done by him. Right? Now, what about the case where, let's say, that I may have not commenced the business. It's very routine exercise that the company is getting incorporated. Now, before incorporation only or during the process of incorporation, some business may have started. Now, the business would have been done by the promoters. So, the process has begun for incorporating company, but meantime, some business income would have arisen. Now, whose business income would it be? Would it be the company's income or would it be the income of the promoters? Are you getting that question? So, the company is into the process of incorporation. And meantime, I have started generating some business income. So now the question arises, whose business income it is? Whether it is the income of the company. After it gets incorporated, the company may ratify whatever the promoters have done and say that this is the business income of company. Or will it be the business income of the promoter group? Yes, what do you think? Yes, students. So carried on by the assessee. The business should be carried on by the assessee himself. Yes. Yes. So a company will become a legal entity only when it is incorporated. Right? The company will become a legal entity. So I cannot do the business in the name of company until it is a legal entity. So prior to its incorporation, it will not exist. The company can enter into any sort of contract only once it has been incorporated, once it's a legal entity. Then the company can decide that, okay, whatever the promoters may have done the business, I can accept that it was done on behalf of the company. But it is the one who has carried on the business. Who carried on the business? The promoters. It is not the company that carried on the business. You may say that the company is ratifying that I have done this particular business, or whatever the promoters have done, it was done on my behalf. So that is a separate thing. But at the moment, who did the business? The business was done by the promoters. So, in one of the case, the Supreme Court held the same thing. That it is the one who does the business will be said to have earned the business income. And therefore, the business income earned by the promoters of the company prior to the incorporation of the company cannot be said to be the income of the company, as the company will become a legal entity only once it is incorporated. So you can write down over here, business done by promoters prior to the incorporation of company, that it is business income of promoters as company comes into existence as legal entity only after incorporation. Business done by the promoters prior to the incorporation of company, even if company ratifies that acts done by promoters were on behalf of company. Key facet per annum, facet per se is meaning he who does it through agent does the act himself. Yes, isn't it very interesting? Yeah, are we clear? So basically what I'm trying to say is that the business profit and gains from the business or profession carried on by the assessee. Now carried on by the assessee means that it has to be carried on by the person who has done the act of business. Are we clear? Next one is at any time. At any time means what? At any time means that even if the business was carried on during some part of the year and not throughout the year, the business was in existence at any particular point of time, and therefore it will be chargeable to tax even if the business has now discontinued. But the question which will arise is, when I say at any time, so if I'm following the accrual system of accounting, I do not have problem because the income will accrue at any time during that particular previous year, even when now the business has discontinued. But let's say when I'm following the cash system of accounting, and business is discontinued. Business is discontinued during the year. Now, how will I account? How will I take it into consideration my income? So, section 176(3)(a) and section 176(4) (176(3)(a) is for business. Section 176(4) is for the profession. These are my specific sections which provide that in case where the business or profession has been discontinued, where the business or the profession has been discontinued in any year, in that particular case, where the business is discontinued, any sum which is received after the discontinuance shall be deemed to be the income of the recipient in the year of receipt. In the year of receipt. Similarly, 176(4) says where the profession is discontinued. Either when I have ceased to exercise the profession or I have retired or the death has happened. Then any sum received after the discontinuance shall be deemed to be the income of the recipient in the year of receipt. So you can write down, this is when I'm following the cash system of accounting. Because if I'm following the accrual system, the income will accrue even if business is discontinued. So 176(3)(a) and 176(4) says that when the business or profession is discontinued, then income, or you can write deemed to be income, in year of receipt. See how the income tax has to be studied. From which section we are going into which particular section? Are you getting that? We are interlinking so many provisions. By now you have done almost 3 ICDS also. If you would have studied, how you would have studied? You would have looked at 28, then you would have gone into ICDS. Now you have even gone into 145, 145A, 145B, 176. What all you have done? So you will realize this when you will start consolidating everything. This is the beauty of the Income Tax Act, isn't it? Okay, get back at any time. The last point is during the previous year. Now, what do I understand by the during the previous year? During the previous year means that the income and expenditure of the previous year is only to be taken into account. The income and expenditure of the previous year needs to be taken into account. So when I say during the previous year means income and expenses of the previous year are to be considered. Income and expenditure of the previous year are to be considered over here. So, the profits and gains are to be computed based on the income and expenditure of the previous year. Meaning, I will not get any deduction of the prior period items. So, I will not get any deduction of the prior period item. Secondly, I will not get any, or I will not have any deduction in respect of the expenditure relating to the future period. So I will not get deduction of the prior period item. I will not get the deduction for the future expenses. So which means what? I will not get deduction for any provisions and the prior period item. So you can write down no deduction for prior period item and provisions. So provision for expense is a future expense, so I will not get any deduction. It has to be income and expenditure of the previous year. Are we getting that? The only exception to this is section 43B, which says the expenditure is allowed to you on the payment basis. This is the exception to this rule. So even if I have incurred the interest on loan during this particular year, I will not be allowed as a deduction in this year. I will be allowed the deduction in the year in which I pay the expenditure. In the year in which I pay the expenditure. Similarly, 40A, which is, or 40A 1A, which is TDS on the payments. If I have not deducted the TDS on the expenditure, it will not be allowed to me in this year. It will be allowed to me when I am deducting the TDS and paying it to the government. Isn't it? So these are the exceptions to this rule. But otherwise, to me, the prior period items and the provisions will not be allowed as deduction. Are we getting that? Now, ICDS 10 talks about the provisions. ICDS 10 is talking about the provision. See, we are moving into another ICDS now. What does ICDS 10 say? Now, ICDS 10 is saying, it is talking about the provisions contingent liabilities. It says provision is a liability which can be measured using the estimation or substantial degree of estimation. It is saying there has to be a distinction between the liabilities and the provision. So, liability means what? I have a present obligation which is arising from the past events and the settlement of which is expected to result in an outflow. And which is going to give me some economic benefits. So, it is not that I don't have to recognize the liability. If there is a certain liability which is capable of being certain and capable of being ascertained. If there is a certain liability, that this is going to be incurred during this year, and I'm able to ascertain the quantum of that liability, then that liability shall be liability in present and that shall be recognized. And that shall be recognized. For example, warranty charges. Now, if I have made the provision for warranty charges, the provision for warranty charges is based on the actuarial valuation. It is based on the calculation as to how many claims have arisen in the past. And based on that, a certain estimation is created. So there is a reasonable certainty that there will be the outflow of resources. A reliable estimate can be made for that. There is an obligation arising out of past event. Then I will recognize that particular provision. Then I will recognize that particular cost of that provision for warranty. In case I am not able to make a reliable estimation or there is uncertainty for that provision that it may or may not be incurred. So provision for a cost to be incurred in future, that will not be recognized. A provision for cost which could be arising based on the past estimate will be recognized. So only those obligations which are arising from the past events that are to be recognized as provision. Are we clear? So just write down what ICDS 10 says. Provision to be recognized. Provision to be recognized when a person has a present obligation as a result of past event, as a result of past event, it is reasonably certain that an outflow of resources embodying the economic benefits will be required to settle obligation and a reliable estimate can be made. Okay, then you have to recognize the provision. Are we clear? You will not recognize the provision when it is of the future cost. Write down provision for future cost, not the direct cost. You can write here example provision for warranties. In exam, there could be an adjustment for the provision of warranty. If it is based on the actuarial valuation, you will allow. So if you look at section 40A9, provision for gratuity, that is not allowed. 40A7, sorry, not 48.9, 40A7, 40 capital A7. Section 40A capital 7, provision for gratuity not allowed as deduction. Similarly, 36.1, provision for doubtful debts. Provision for doubtful debts not allowed as. Are we clear? Yes or no? Profits and gains from the business or profession carried on by the assessee during the previous year. Yes. Is this clear? Just go through it once again. I'm giving you 1 minute time. Yes, go through it once so that you can consolidate everything and then we can move ahead. Okay. Any questions? Any doubt? Fine. Shall we move further? Okay. Now, one very important thing over here. So, profit and gains, as I said, as per the commercial principles of the accounting. Now, here you have to take only the revenue profits, as we rightly discussed earlier also. You don't need to take the capital receipts. So, in this connection, just write 2 points over here, because here you are required to take the capital revenue profits and not the capital profits. So basically, 2 important points you have to write over here. You also need to take into consideration, while computing the profits, you also need to take into consideration the losses. So you can write it over here itself. Loss of stock by fire, allowed as deduction, because you need to determine the profits as per the commercial accounting principle. So consider the revenue losses also. For example, you may receive, let's say, compensation for supplier, for supply of, or for delayed supply of raw material. Compensation for, sorry, first write it like this. Consider revenue losses, consider revenue receipts and not capital receipts. So if I say the compensation for delayed supply of raw materials, then this is going to be my trading receipt. This is my trading and the revenue receipt. Fine. If it is of the capital nature, then I don't need to account for that. If it is a capital receipt, then I don't need to account for that. Only when it is a revenue receipt, I need to account for that particular income. Right? Now, one more example, if you remember, I had given you Saurashtra Cement Limited case. Liquidated damages received for delay in supply of machinery. When you receive the liquidated damages for delay in supply of machinery. So when you are receiving the liquidated damages for delay in supply of machinery, it is a capital receipt. It is a capital receipt, right? So that you will not take into consideration. That you will not take into consideration, right? So when it is a capital receipt, you will not take into consideration. But when it is a revenue receipt, you have to take that into consideration. Are we clear? Yes or no? Yes. Clear? So loss of stock by fire, you will allow. But let's say if it is some loss which is arising on the plant and machinery, let's say for example, you have paid the advance money towards the procurement of plant and machinery. Now the plant and machinery is supplied to you in a, let's say, damaged condition. So you forfeit the advance. You forfeit the advance which you have basically the advance money which you had paid towards the procurement of plant and machinery. If, say, for example, you are not fulfilling the terms and conditions of the contract and that advance money is forfeited. So that's in fact a capital loss. That is a capital loss and that will not be allowed to you as deduction. So if you have made the advance for the procurement of plant and machinery and let's say tomorrow you are not taking the delivery, then that advance may be forfeited. So that is a capital loss. That in fact you will add it the cost of the plant and machinery. That you will add it to the cost of plant and machinery and you will be able to claim the depreciation on that particular part. Right? But where, let's say for example, you have received the compensation for the stock in trade which is delayed or the material which is delayed, that is a trading receipt. If you have received the compensation for the delay in supply of machinery, that is a capital receipt. That is in fact a capital receipt. Right? So you can just write it over here. Sorry. Compensation for delayed machinery, capital receipt. Which case law? Saurashtra Cement. Remember we had done it in the basic class. Okay? Right? Yes or no? Any questions? Any doubt? Okay? Yes. Now we move on to the 28.2. So 28.1 was profit and gains from any business or profession. Well, profit and gains we understood, business or profession we have defined. Carried on by the Atati. Again, that is what we saw. And then at any time means the discontinued business income will also be taxed when it is received during the previous year, meaning the income and expenditure of the previous year provision, unless it is ascertained as per ICDS 10, will not be recognized. Now section, this was the general charge. Now there is specific charge. Now specific charge 1 is under 28. Now what does 28.2 talks about? Now section 28.2 is in relation to 28.2 is in respect of the income or the profit and gains which are arising from the compensation which is received. The compensation which is received by any person who was, let's say, managing the affairs of the company and his contract has now been terminated. So, if let's say, for example, I was managing director of the Indian company and they have terminated my contract and they are giving me the compensation. So in that particular case, this is in fact a capital receipt. This is a compensation for the sterilization of the profit-making apparatus. Saurashtra Cement, 48, basic concept class. What did I tell you? The liquidated damages which are received as a compensation for the sterilization of the profit-making apparatus is a capital receipt. Capital receipts are not taxable unless specifically charged to tax. That is why 28.2 is a specific section. 28.1 is a general section. It says profit and gains arising from the business or profession carried on by assessee. Profit and gains means what? Computed as per the commercial principles of accounting, which means only the revenue profit which has to be taken. Since under 28.1, this cannot have been put up, there is a specific charge which is created under 28.2, which says that if there is a compensation which is received by the managing director or any person who is managing the affairs of the company, which is also in the nature of the sterilization of profit-making apparatus, compensation for sterilization of profit-making apparatus. They have terminated my contract. Now they are giving me the compensation. Ideally, it's a capital receipt, but it is specifically charged to tax. Are we getting that? So 28.2 which is there is in respect of the compensation. Or if I am, let's say, an agent and they are terminating my agency contract, and in relation to that, they are giving me compensation. Or let's say, for example, there is compensation for the termination of any contract relating to the business. Then that shall be specifically charged to tax under 28. Now one can argue that what was held in Saurashtra Cement case is no longer valid because of 28.2. If you look at 28.2, it says the compensation which is received in connection with the termination or the modification of any contract relating to business. So where there is delay in supply of the machinery and for which I have received the liquidated damages. So the contract gets terminated if the machinery is not supplied to me. If the machinery is supplied, even if it is delayed supply, then it's fine. But let's say the contract gets terminated. Then in that particular case, though it is a capital receipt, but it will be specifically charged to tax under 20. Because it says any contract of business which is terminated or the terms of the contract are modified. So when there is delay in supply of machinery, the terms of the contract are modified. So the compensation that I am getting will be specifically taxed under 28.2. Are we getting that? So just write down. Compensation for termination or modification of terms and conditions of contract of managing the company, agency contract, or any contract of business is specifically chargeable under 28.2. So you can write down even though the compensation is towards the sterilization of profit making apparatus, which would be a capital receipt, This is comma, this is specifically chargeable under section 28. So you can write it over here in the red pen. Therefore, compensation for delay in supply of machinery, compensation for delay in supply of machinery, compensation, or you can write down, or liquidated damages for delay in supply of machinery is arising out of modification in terms and conditions of business contract, taxable under section 10. Taxable under section 20. So you can mention it over here as well, where we wrote about Saurashtra Cement, compensation for delayed machinery, capital receipt, Saurashtra Cement, refer 28.2. Specific charge. So why I did not cover at that point of time was because I wanted to cover with this. Even you will go to your basic concepts page where you have written for the Saurashtra Cement capital versus revenue receipt. Remember here we have written compensation or liquidated damages paid for sterilization of profit-making apparatus. It is a capital receipt, but you will write it over here. You will write it over here. Sorry. I think some issue. 1 second. So you will write over here specifically charge under section 28. Right? Yes or no? Yes? Okay. Next is 28.3. Next is 28.3. So 28.3 is about the income derived by income derived by trade professional, or any association from trade or professional association from specific services performed for the members. Performed for its members. Now understand here one very important thing. See, there are these associations, right? The clubs which are there basically, or for that matter, cooperative societies which are there, right? Or there are these, basically gym khanas which are there. These are all the association of person, right? What they do is basically they come together, the members come together and they basically contribute the money, and with that contribution, they take care of the welfare of the members, right? So basically the chit fund companies which are there, or for that matter, certain cooperative banks which are there, the cooperative societies which are there. Look at your cooperative society. You may be, staying in some cooperative society. It's very common these days. What happened? They collect the maintenance charges. And what do they do with the maintenance? They incur the expenses from the maintenance. Basically, let's say, for example, for the clubhouse. Who will use the clubhouse? You will only use the clubhouse. They will pay to security guard. They will pay to housekeeping. They will pay for lift repair, lift maintenance. They will pay for, let's say, gardening, for the gym maintenance. So all of this is for your own benefit. So the amount which is collected from the members is utilized for the welfare of the member. Similarly, if we look at any clubs or gym khanas, what they do is they specifically collect the entrance fees. And this entrance fee is utilized for providing, let's say, a sports club, a gym inside that club, a swimming pool inside that club to the members only. So basically, there exists a principle of mutuality. There is this principle of mutuality, which says what? One cannot earn profit, one cannot earn the profit by trading with itself. So one cannot make the profit from one's own self. One cannot make the profit from one's own self. One cannot earn profit from one's own self. So the example of this is cooperative societies, gymkhana, clubs, right? They collect the membership fees and they utilize it for the members. So basically, there is no question of profiting. Why will I earn the profit in that? I'm just collecting for the expenses that I'm incurring. So based on the principle of mutuality, the income is not included in my total income because I cannot profit from my own self. It's a group of members coming together, forming an association and carrying out their activities, and that is how they are collecting the memberships and incurring the expense. So that income is not at all included in the total income based on the principle of mutuality. Income not taxable because one cannot earn profit from own self. However, if it is income derived from the specific services performed for the members, then 28(3) creates a specific charge. Now we didn't understand. So principle of mutuality is in respect of the general income which is not taxable. So income which is of the general income from all members. Right? So the example of this will be entrance fees, maintenance, memberships, right? But if let's say, for example, I'm giving the hall, I have a gymkhana, I have a hall inside that. I'm giving the hall on rent to the specific members and I'm collecting the rental charges for that. Are you getting that? That is a specific charge which is covered under 28. That will not be governed by the principle of mutuality. That I'm collecting it from a specific member and doing the business. So that will be charged under 28. So income derived by the trade professional association from specific services provided. Example, hall on rent to specific member. So that shall be chargeable to tax under 28. Getting it? But as far as the general principle of mutuality is concerned, as I said, income will not be taxable if it is from the general services provided to all the members, because one cannot profit from one's own self. But in case there is a loss, income will not be taxable. But what if there is a loss? For loss, we have, in case of loss on general services. In case there is a loss on specific service, that is allowed under 28(3). It says income from the specific services performed for its member. So now income will mean income which is revenue minus expense. Now if the expense is higher than revenue, any which ways we will get a deduction under 28(3). It says income, it doesn't say revenue, right? It could mean income will include even the loss also. But in case of the income from the general services, the income is exempt based on the principle of mutuality. It is not exempt under 10. It is exempt on the principle of mutuality that one cannot profit from one's own self. But what if I have a loss? What if I have the lesser maintenance charges and I have made the more expenditure on clubhouse, security, housekeeping? What do I do in that case? So in case of loss on general services, we have a specific section 44A. See how we are interlinking the provision. Now 44A provides that if in case of the trade professional or similar association, where the amount received from the members other than for the specific services, because specific services you have already under 28(2), where the amount received is less than the expenses. So expenses are greater than the amount received other than from specific services, then not being the capital expenditure. So expenses may be revenue and not capital expense. So if there are expenses which are incurred for the purpose of the common interest of the members, which are greater than the amount received from the members, then there will be deficiency. They use the term deficiency and not loss. So in case there is deficiency, then that deficiency will be allowed as deduction in computing the income of that association. Right? So then the deficiency will be allowed as the deduction. Now what will be the deficiency that will be allowed? That is what is given under 44A. So 44A says that in case you have the deficiency, we will allow you the deduction under 44A. Now, what will be my deficiency which is allowed? Which is the half of the total income. Which is the half of the total income will be allowed as the deficiency. Half of the total income will be allowed as the deficiency. So just write down. Write down over here. Half of the total income restricted to half of the total income. So whatever my total income will be, half of that will be allowed as the deficiency. Deficiency allowed as deduction, restricted to half of total. Restricted to the half of the total income. Yes? Any doubt? Any questions? Any doubt? Yes or no, students? So we have done 28.1, 28.2, 28.3. Right? And in 28.3, we have also done the 44A provision. Yes or no? Then we have certain specific 28.3A, which is profit on sale of license, cash assistance which is received, the duty drawbacks which are received. All of that is specifically charged. Now you may say this is a capital receipt because the cash assistance which is received from the government, subsidies, profit on sale of import licenses, duty drawbacks, these are all capital receipts, but these are specifically charged under 28 section 28.3A to 3E. 28.3A to 28.3E, this covers this covers the subsidies, profit on sale of duty entitlement license, subsidies from government, then duty drawback, all of that is specifically charged to tax under 28.3 to 23A to 28.3E. Fine. Now 28.4 is what we'll do in the next class because that is very, very important. 28.4, 28.5 and 28.5A and 6. This we will do it in the next class. Okay. So any questions if you have, we can just discuss. Otherwise, we can just close the session. Also, I will request you to keep revising. In the next class, we will finish off 28. We will start with 30, 31, 32. 32 is very, very important. Again, depreciation. And then we will go with the general deductions which are there. So PGBP, we have 3 more classes remaining, right? For the PGBP, next class will be devoted to depreciation and some general deductions. And after that, we will cover the specific deductions. Okay. So we are already done with 2 classes of PGBP and remaining we have 3 more classes on PGBP and then we will have the capital gain. Okay. Any question, any doubt? Thank you so much, Vanshika. Okay. So we can just close the session for today. Thank you so much. Yes.